When Biden sanctioned Russia, and I said this at the time, that those sanctions were sending a powerful message to the whole world to get rid of dollars and not to use the U.S. dollar and U.S. treasuries as a reserve because we could, yank them out from under you whenever we want. But I think what's even more significant is a long overdue realization that the U.S. cannot possibly repay its debt, honestly, that the national debt, which is now $38 trillion, there's no way the U.S. government can repay that debt in money that isn't dramatically debased. If you figure this run, we broke out at 2000 was the highs, and, we've gone maybe double from 2000. So it's not anywhere near the type of rally that we've saw in the past.
Schiff argues that the recent surge in gold and silver is less about speculative fervor and more about a deepening structural shift away from the dollar. He notes that gold has recently hit record levels above $4,000 per ounce, and silver has broken through $50 per ounce, surpassing past peaks. He asserts that the US dollar is under intense pressure, eroding purchasing power, losing its reserve currency dominance, and that this weak dollar dynamic is a primary driver behind precious metal strength. Gold prices tumbled sharply this week, marking their steepest drop in over a decade. Spot gold fell 3% on Monday and another 1% Tuesday to $3,963.53 per ounce, extending a near 10% slide from record highs of $4,381 hit earlier this month. The drop came after a surprise US-China trade framework deal at the ASEAN summit, which removed the threat of 100% tariffs and eased geopolitical tensions that had boosted gold earlier this quarter. Now, we present the clips from Peter Schiff interview. Please don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the rest of the video.
But now it's not the U.S. going off the gold standard. It's the world going off the dollar standard and returning to the gold standard. And I think that's probably even more significant, certainly for the United States, because we're about to have the rug pulled out from under us. And, we've been living off of the dollar's reserve status. We've used it as a crutch to live beyond our means. We've enjoyed lower consumer prices and lower interest rates and higher asset prices as a result of this privilege that I think we are in the process of losing. So when you point to these other moves up in gold and silver, I think they were largely driven at the peaks by speculators, by retail investors who were, jumping on the bandwagon and pushing the markets to, kind of extreme points, and then they would go down. I don't think we've even seen that yet. I think that retail investors have barely participated. In fact, if you look back at the flows from all of last year and most of this year, retail investors were selling gold ETFs. They were selling gold stock ETFs. So they sold into the rally. They weren't buying. In fact, if you talk to a lot of the smaller coin shops around the country, and I've seen interviews, most of the people that came in over the last few months were people that were selling their gold. They were like bringing in their jewelry to melt it down and get some cash. It wasn't a frenzy of people looking to buy gold. And the institutions, are barely involved. The pension funds, the endowments, hedge funds, they barely have any position in gold. It wasn't until just recently that you saw, more talk from, Ray Dalio although Jeff Gundlach has been talking gold for a while, but a few other people. Morgan Stanley came out in the last month. I think one of their analysts said that we should tweak the 60-40 portfolio to be 60-20-20, where you split your bonds in half and you buy gold. But I doubt they've had any opportunity to make the switch. They've just started to recognize gold's value after denying it for decades. I've been in the investment business for, over 35 years, and I was pretty much a lone voice, as a stockbroker, telling my clients that they should have an allocation to gold in their portfolio. Yeah, when I went on major financial networks to talk about it, they generally laughed at me, or they accused me of fear-mongering or just trying to sell gold. They didn't accuse a stockbroker of recommending a stock because he's just trying to sell stocks. And of course, I was both, right? I was in a stockbroker, but I also thought that people should have gold as part of their portfolios. But that was sacrilegious. But now people are starting to say, hey, wait a minute, given the fact that gold has outperformed stocks over the last 25 years, if you go back to 1999, when the Dow peaked at 45 ounces of gold, today it's worth, it was 11. I didn't do the math today, but it was, just recently down to 11. That was a 70% decline in the price of the Dow Jones measured in real money, measured in gold. And given the fact that just holding gold, in a shoebox beat the Dow. And I'm not talking about just the price. It actually beat the return because the dividend yield has been pretty low over these years. You actually did better just holding a gold coin. And so I guess, given that, I think Wall Street finally recognizes that, yes, gold has a place in your portfolio. And if that's the case, well, this rally has a long way to go because that means a lot of investors have a lot of gold they need to buy. Meanwhile, the central banks are getting started. I don't think they're nearly complete in their transformation of their reserves. They still have a lot of dollars to get rid of and a lot of gold to buy. Yeah, well, first of all, the peak in 1980, that's when gold went from $35 to $850. So that is an enormous move. I mean, we're not even close to that, that type of move this time. And in fact, even the 2011 peak, gold started that run about 10 years earlier at around 250. So we went from 250 to 1900. And if you figure this run, we broke out at 2000 was the highs. And, we've gone maybe double from 2000. So it's not anywhere near the type of rally that we saw in the past. And even if you measure it from the low of the correction after it hit 1900, we're only about a 4x move from that low when gold pulled back to 1050. So I think even relative to those other big moves, this one is still pretty early. I think it has a ways to go. But yeah, I mean, gold had started to move up very rapidly. So it doesn't surprise me that it pulled back. I mean, it was a pretty violent pullback. We had a 6.5% decline just in one day. And of course, the biggest moves in bull markets, and that this goes with anything, not just gold, but in stocks or, it's always the downside, right? In a bull market, the biggest moves are down. Like in a bear market, the biggest moves are up. And they generally shake out the weaker players. They create a lot of fear that, it's over, time to get out. And they're usually very violent, but they end very quickly. And while a lot of people are frightened of the move, they end up missing out on the opportunity to buy. And I think that's going to be the case with this shakeout. I think gold is going to keep moving up. I think, it's probably healthy that we had a big pullback to kind of keep the speculators in check. The people who come in on leverage and use tight stops, a lot of those guys probably got flushed out in the pullback. We had a big drop in the mining stocks, far more than we did in the price of gold. In fact, a lot of mining stocks ended up losing all the gains, I think, since about 3,700 gold, even though gold is now about 4,100 and change. And there are many gold stocks that are already in bear markets, technically, that in a couple of days have dropped by 20%, as if, everything is falling apart. But we're above 4,000. I think it's interesting that the low of the pullback so far was still above 4,000. So when you're talking about we had this huge sell-off, but gold was still above 4,000. I mean, we didn't sell off from 4,000. We sold off to 4,000. And so I think it's, gold's made some good progress, but most of it has come based on central bank buying. There's very little retail investor interest.
Peter Schiff argues that the current strength in precious metals, particularly gold and silver, is being driven by a weakening US dollar and a fundamental shift in global monetary behavior. According to Schiff, the dollar's long-standing dominance is deteriorating as inflation erodes purchasing power and foreign economies diversify away from US-denominated reserves. This erosion of confidence is pushing central banks, especially in emerging markets, to accumulate physical gold as a hedge against currency debasement and geopolitical uncertainty. Gold's recent upward movements, even with short-term volatility, reflect this structural transition rather than speculative excitement. Schiff maintains that the metals market is in a sustained bull cycle, supported by institutional accumulation rather than retail hype. Silver, he emphasizes, is the most undervalued component of the precious metals complex. Its dual role as an industrial input for advanced technologies and a historical monetary asset positions it for potentially explosive gains once investor sentiment fully turns. Let's watch more clips from the interview.
And I think that's what a lot of other central banks are doing. They're buying gold to restore gold as, the monetary backing of their currency. And this, I think, is a major, transformation in the global monetary system. I think it's on the order of, or maybe bigger than what happened in the 1970s when we went off the gold standard. And so the world went from having the US dollar backed by gold as the reserve to just having a fiat currency as the reserve. That was a significant shift in the monetary order. But I think what's even more significant is a long overdue realization that the U.S. cannot possibly repay its debt honestly. That the national debt, which is now $38 trillion, and of course that's just the bonded debt, not with all the unfunded liabilities, but the treasuries that a lot of foreign central banks own, there's no way the U.S. government can repay that debt in money that isn't dramatically debased, meaning that the U.S. government will not be able to raise sufficient tax revenue to make good on its obligations. The Fed is going to have to print the money. And also, we have so much debt now that we can't even afford to pay a rate of interest that would be commensurate to the loss of purchasing power that you might experience holding U.S. debt to maturity. And, that's why Donald Trump is beating up the Fed to cut rates. In fact, that's why the Fed is cutting rates, even though inflation is well north of their, bogus 2% target and headed higher, right? They're cutting rates when they should be hiking rates. And it's mainly because we can't afford the rates that we have now, let alone the rates that would be required to restore inflation to 2%, right? So we're cutting rates. But we're letting our creditors know that if you hold dollars or treasuries, you're going to lose. We are going to debase what you're holding, and we're not going to pay you a rate of interest that's anywhere near close to compensating you for what you're going to lose to inflation. And so I think given that, the world has made a decision to get out of dollars. And so I think you're going to see the weakness in the dollar against other fiat currencies. I mean, clearly, when gold is at 4,000 and it was at 2,000 2 years ago, the dollar's lost half of its purchasing power in terms of how much gold you can buy with your dollar. So the dollar is losing value against real money right now, but so are the pound and the euro and the yen and all these other currencies. But I do think that you're going to start to see the dollar losing a lot more value relative to its fiat counterparts, either before the end of this year or next year, and that's going to accelerate the increase in the price of gold in dollar terms. But I think it's already giving you a forewarning that that's going to happen. I think gold is rising as a reflection of a loss of confidence in the dollar, because I think the main reason that gold is being accumulated is because central banks have lost confidence in the dollar and in the fiscal responsibility of the U.S. government or the credibility of the Federal Reserve. So you're seeing it first in gold. I think you'll next see it in the dollar, and then I think you'll see it after that in the Treasury market, where you'll start to see a big drop in bond prices and a rise in long-term yields, despite the fact that the Fed is going to be reducing short-term rates. And I think that is going to be the catalyst for a return to quantitative easing, because I think the Fed is going to try to lower long-term interest rates through its open market operations, where it needs to print money to buy the bonds that the rest of the world is selling. And so that, I think, will be another catalyst to drive gold to even higher levels, because that's just massive inflation. And, the last couple of times we tried QE, inflation, at least the way the government purports to measure it, was below 2%. So the government was able to justify QE by saying, look, inflation is below target. And so we could do this because the goal is to get inflation higher to reach our target. And so, we're going to accomplish that with QE. But if inflation is already well above 2%, what is the excuse for creating more inflation? How do you justify QE when inflation is 4 or 5%?
That's
the way
simple,
the government
Peter.
measures it. I don't think they could do that, because just moving it to 3%, once you move the goalpost once, right? Well, now you've already broken trust, because if you can move it to 3, you can move it to 4. But even moving it to 3, is a big game changer, because that means a 50% increase in annual inflation. So, what does that do to the present value of gold if inflation is going to be 50% higher from now until the end of time? But of course, they're not going to achieve 3, because if they give up 2 and they move to 3, well, then they're going to give up 3. They've already proven that their target is BS when they're above it. They don't have the monetary cojones to do what it takes to bring inflation down to 2%. Well, then why would they have it to bring it down to 3% or 4%? So I think, once they move it, they're done, which is why they probably won't. I don't know that they're officially ever going to say that they have a target of 3. I think they're going to keep a target of 2, but they're just never going to hit it. And I thought it was really ridiculous. In the last FOMC meeting, somebody actually asked Powell about about his forecast, because he pointed out, hey, 2 years ago, you predicted that in 2 years inflation would be 2%. And now it's 2 years later and it's way above 2%. And you're still predicting that 2% will have 2% inflation in 2 years. And he said, why should we believe you? What makes you more confident now than you were 2 years ago when you made the same prediction? And Powell basically said, look, we don't really know where inflation is going to be in 2 years. It's just that 2% is our target. So that's our forecast. We just assume that we're going to hit our target, but we have no idea. So in other words, they just make it up. The only reason they forecast 2% is because they want it to be 2%, not because they think it's going to be 2% or they have any reason to believe that it's going to be 2%. So they could just keep on talking 2% inflation, just to pretend that they've got that target. But, we're not going to go anywhere near it.
Schiff believes that Western investors remain underexposed to precious metals, leaving massive untapped demand ahead. If confidence in fiat currencies continues to erode, a global repricing of tangible monetary assets will follow, allowing both gold and silver to reach new, significantly higher price levels in the coming years. Let us know what you think in the comments, and if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution. Thanks for watching.